Hello, everyone. Welcome to this week's webinar. My name is Joe Torre. I'm one of the investment counselors here at RealWealth Network. And in keeping with the holiday season of Halloween, we have a special webinar today on investing horror stories. And today we're going to focus on 1031 exchange horror stories. So before we get started, a few housekeeping items. For those of you who will be on the West Coast this weekend, we're having our live events. The focus will be on Florida. Our Jacksonville affiliates and our Tampa affiliate will be presenting live in person on Saturday, October 20th in San Mateo near the San Francisco airport, Sunday in LA near the airport there, and on Monday night in San Diego. We'll also have a presentation on Costa Rica and an update on that. And Kathy Fetke will be there for all three events, so you can meet her in person. If you want to register, you just go to our website at realwealthnetwork.com/live-events, and you can register for free and attend. Also, we always like to start with a disclaimer that the strategies mentioned in this presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstances. Consult your personal accountant, tax advisor, or attorneys, or in this case, your 1031 qualified intermediary to discuss your specific situation. Especially for something as technical as 1031, you want to talk to a professional. Past performance is no guarantee of future results. Real estate purchases are subject to investment risk, including the possible loss of amounts invested. And while every effort is made to maintain accurate and current information, the possibility of errors, updates, laws changing, that sort of thing always exists. Okay, our agenda for today. First, I'll introduce the presenters, myself and my partner there, Dino Champagne. Dino will take us through a review of 1031 fundamentals, just to level set and make sure everybody's on the same page. And then we're going to go through 10 common 1031 mistakes that we've seen people or investors make over the years, and they fall into a couple of categories. Some have to do with bad timing, missing the deadlines. Others have to do with not understanding the 1031 exchange rules and breaking them. And others have to do with the choice of replacement properties. At the end, we'll have time for Q&A. So if you look on the upper right-hand corner of your screen, you should see a rectangular orange box with an arrow pointing to the left. If you click on that, there's a dialog box. You can type in your questions throughout the presentation, and then at the end we'll catch up and do all of them, as many as we can. Okay, about the presenters, yours truly is on the left. I'm a RealWealth Network investment counselor. I'm here in the Bay Area. I've been working in high tech for 20 odd years. Been investing in real estate since 2004. Decided I like real estate better and gradually transitioned, and now I'm working for RealWealth Network full-time as an investment counselor. Our 1031 qualified intermediary is Dino Champagne, who you see on the right there. She's one of our preferred 1031 experts. She's done over 10,000 exchanges in her career. So she's done it all and seen it all. She's taught thousands of seminars on 1031s, even teaching the IRS Long Beach office how 1031s work. So, you know, when they need an expert on 1031s, they brought Dino in. So, Dino, are you there?
I'm here.
Okay,
Thank
great.
you, Joe.
Glad to have you aboard. All right, I'm going to turn this over to you so you can go over the fundamentals of 1031 exchanges.
Very good. Well, welcome to this afternoon seminar, and we actually love the number 1031. Our company, Asset Preservation, was actually founded on October 31st. Very appropriate, since this is the tax code that we specialize in. So we love 1031 this time of year. We love it all time of year as well. Okay, so what we're going to do this afternoon is we're going to go through the basics of the 1031. So let me just take you through and review what it is. Section 1031 actually is a part of the tax code, which allows an investor to defer paying tax when they sell an investment property. So as an example here, we're showing you that someone's selling a property for $1 million. Okay, and their cost basis in the property is $300,000. Now, just to touch on what is the cost basis, basically that means what did you originally pay for the property, any capital improvements that you had while you operated the property, depreciation, all those numbers come into play, and that'll get you an adjusted net basis to get your cost basis. So you need to know what your cost basis is when you're trying to determine what your gain is going to be, and therefore what the tax implications are. So in this example here, we're saying the cost basis was $300,000. So looking at selling for $1 million, cost basis $300,000, the gain would be $700,000. The tax implications on that could be $167,000. Now that's only at the federal level. That's assuming a 20% tax rate for long-term capital gains, plus the 3.8% for the Obamacare, known as the net investment income tax. That number that's in our slide here does not reflect whatever your state income tax may be. So in a situation such as this, you're going to end up with a potential having to pay with cash to be able basically reinvest only $533,000. Let's just say you're in a no income tax state. When you're doing an exchange, you get to defer that tax, and you're able to reinvest $700,000 into the next property. Now, this is some very broad assumptions here, okay, but just taking you through why people do an exchange, because they want to defer the tax and then therefore redeploy that money to buy more assets. Next slide. Now, there are certain rules that you have to comply with, but let's just go through the cycle of an exchange. When you're deciding to sell an investment property, there are a couple of people that you should be talking to in the beginning to determine whether you need to do an exchange and how an exchange would work. The need to do an exchange, that would be your tax advisor. So whoever is doing your income taxes, that's the person, that would tell you, yes, Joe, you can benefit from an exchange. This is what you would pay in taxes. And then you consult somebody like myself, a qualified intermediary, because at that point, I'm going to take you through the process of the exchange, what to expect, the timing, the rules, the guidelines. So that's going to be my function. Then you'll list your property with a real estate professional. Once it's under contract, that's when my role as the qualified intermediary will officially begin. We, as a qualified intermediary, must be assigned into your contract prior to the closing of the sale. So what happens is once you open up your escrow, for those on the West Coast, it'd be an attorney if you're on the East Coast. Once you open that up, then at that point, we now, as a qualified intermediary, are going to communicate with whoever's handling your closing. There's going to be documents that we're going to need from them in order to prepare our exchange agreement. The exchange agreement is the linchpin that's going to keep this whole thing together, because you must have a qualified intermediary and you must have an exchange agreement in order to qualify for a 1031. We're going to prepare the exchange documents. The exchange documents must be fully executed, signed, prior to the closing of your sale, okay? Once that takes place, when the closing happens, so the buyer comes in with their money, then the proceeds are going to be wired directly to us. That's when the time frame for the exchange will officially begin. You have 45 days from the date of closing to identify any property or properties you would like to acquire. After the 45 days, you have an additional 135 days to complete your exchange. So an exchange from beginning to end is no more than 180 calendar days. Now, let me just add a little caveat here, because we're at this time of year. The tax code says that the taxpayer must complete the exchange within 180 calendar days or their tax filing date, whichever is earlier. So if you're closing on a sale between now and December 31st, in order to get the full 180 calendar days, you would need to file an extension on your 2018 tax return. Okay, so that gets the conversations in my world get a little longer because of the 180 day or your tax filing date. Now, and then to finish the cycle, and then we'll drill a little bit deeper onto the identification. But to finish the cycle, once you find a replacement property, we also have to be assigned into that contract. When you're ready to close, we're going to wire the funds that we're holding into the closing, and then you're going to be on title to the property. So that is the flow of the exchange. So as you can see, the qualified intermediary is the seller and the buyer. However, in a forward exchange, we never, ever go on title. It's our documents that allow us to do what we do. Okay, so let's talk about the other qualifications. Okay, Joe, you want to go to the next slide? Okay, when we talk about identifying property, okay, one of the things that's very important about the 1031 process, it's this tax code is for investment property or property held for a trade or business. This is not something for your primary residence. If you are living in the property and it's not a duplex, it's just a single family home, you're not going to be doing a 1031. This is for investment property only. So both the relinquished property and the replacement property must be property that you intend or have held for investment purposes. Now, one of the questions that comes up often about 1031s is the term like kind. Sometimes folks think that the term like kind is very, very literal. So in other words, if I'm selling a single family rental, in order for it to qualify for like kind, I must buy another single family rental. Or if I'm selling raw land that I held for investment purposes, I must buy raw land. That's not the case. Basically speaking, it's investment real estate for investment real estate. So I can go from raw land, which is generally not income producing, to improved property like an apartment building or a duplex. So I'll end up having some value to it and getting some income from that property. So as you can see, it's very broad. So it's investment real estate for investment real estate. Now, things that do not qualify. You cannot exchange, and this comes in, the question does come in often, and if Kathy's having a seminar on Costa Rica, you cannot exchange U.S. property for any property in Costa Rica or any other country. It's U.S. property for U.S. property. If you happen to have foreign property, you can exchange foreign property for foreign property if it makes sense to and if the property is held for investment purposes. Another component that does not qualify for an exchange would be properties that you intend to fix and flip or build and sell. That's considered dealer property and doesn't qualify for 1031 treatment. Okay? So let's take you through the next guideline now. So you understand that you have to have the qualified intermediary. In the first slide, pretty much we talked about what the gain was. And this comes up often because people get a little bit confused. They go, well, what do I have to reinvest in order for it to qualify for an exchange? Well, in our first slide, we talked about your gain being $700,000. So people think, well, I just have to invest the $700,000 for the gain. That's not the case. What happens in an exchange is when you're thinking about doing an exchange, it's a continuation of ownership. So while I've owned, say, for example, a single family rental, and I have gain when I sell it, I don't want to pay the tax. I am continuing my investment, albeit with another property and possibly in a different geographical location. When I do that, I am bringing not only my gain with me to the next property, but also my basis. So one of the requirements to try to defer 100% of the gain is to purchase property equal to or greater than your net sale price. Now, there are going to be certain closing costs that are going to come into play when you're selling a property, such as the commission, title, the closing agent, any potential legal fees, the qualified intermediaries fees, transfer tax. Those are acceptable closing costs. So in the example here in the slide, it shows I'm selling for $1 million. My closing costs are $100,000. So that means my net sale is $900,000. I have a loan of $500,000. So that means the cash that's coming into the exchange is $400,000. So when we're talking about doing deferral, I have to spend all of my cash and I must replace the existing debt or the loan that I had on the property. So therefore, I am buying property equal to or greater than my net sale price. So as you can see in this example, I'm not just buying something for $700,000. I have to try to buy something for $900,000 or more. Now, I want to talk a little bit about the loan aspect of this because sometimes individuals get a little bit confused about that. In this case, the example, we have a $500,000 loan, so that's a pretty good sized loan. But if somebody only had a $75,000 loan, maybe they don't want to go get a new loan on the next property. Maybe they want to bring in cash from outside to replace that loan that they had. That is totally acceptable in an exchange. As long as you're buying equal to your net sale price, spending all of the cash that we have, and you're bringing in your own money to replace the debt that you had. Okay? So just be clear that you don't have to go out and get a loan if you have your own cash outside of the exchange to find the replacement property. Now, that may not be your best investment strategy. That's what you'll talk to Joe about later, okay? That's always good when you want to use, for using other people's money. So when you're doing an exchange, remember that you have to buy property or properties equal to or greater than your net sale price. All right, so let's just refresh our memory again about the timeline. Next slide, Joe. Okay. When we talk about the 45 days and 180 days, very, very important to understand that we're talking, when we say these days, 45 and 180, these are calendar days, not business days. So let me repeat that. These are calendar days, not business days. And sometimes we get into these situations during the 45-day period or the 180-day period where the investor's not focused on the fact that it's calendar days. They're thinking it's business days, and that's not the case, okay? It's 45 calendar days from the date of closing. So, for example, if your 45th day fell on a Saturday or a Sunday or a legal holiday, your identification still must come in during that period. If it comes in after that, then you have not fulfilled the identification requirement. So it's always best to try to bring in the identification before, if it's falling on a weekend. Okay, that way everything can be checked out. The same with the closing. If you're scheduling your closing and you're not paying attention and you go, okay, I'm closing on Monday, but your 180th day fell on Saturday or Sunday preceding the Monday, then you've missed your exchange time. You would need to close the Friday before, okay? So these timelines are very real. They're not arbitrary. They're in the code, and they must be complied with. All right, so let's go into the next guideline, which is about the identifying. When we're talking about identifying, this can get a little bit confusing for some folks. There are three rules. We're going to only focus on two because most people don't use the third rule. But the most commonly used rule is the three property rule. So you can identify up to 3 replacement properties. The fair market values of those properties are not, it's without regard, okay? So if I'm selling for $1 million, I identify one property for $1 million, one for $1.2 million, one for $1.5 million, that's fine, because I'm limited to physically 3 addresses, okay? Now, when we talk about identifying, let me just stop here for a second. And when I talk about what we mean by identifying, I like to say that there's 2 avenues. There's the technical, which is my world, and then there's the practical, which is the transaction. The technical means that you, as a taxpayer doing an exchange, will complete a piece of paper that's usually provided by the qualified intermediary. You're going to put on that piece of paper the address, the city, the state. You're going to sign it, and you're going to date it. That's the technical aspect of identifying. You do not have to be under contract. However, from a practical standpoint, you should be under contract with something because you can only purchase what is on that list. And after the 45th day, you cannot change your list. So just understand when we talk about identifying, there's the technical and then there's the practical. All right, so there's the 3 property rule. Unlimited number of dollar amount, but limited to physically 3 addresses. Now, the next rule which could be used and is being used actually quite often. And when somebody is selling from a high valued area, say for example, like Los Angeles or San Francisco, and they want to reinvest somewhere like Jacksonville, Tampa, okay, that particular market. Well, if they're going into single family homes, then you're going to be able to buy a lot more in those markets than you probably will under the price points in San Francisco and Los Angeles. So you might have the opportunity as an investor to utilize the 200% rule. Now, the 200% rule allows a taxpayer to identify 4 or more properties. So they're not limited to physically 3 addresses. However, what comes into play is going to be the dollar amount for those properties that you're going to be identifying, okay? So you're limited to 200% of your sale price under the 200% rule. So in effect, if I identify, for example, say 10 properties, and I'm selling for $1 million, when I add up the fair market values of those 10 properties, it cannot exceed $2 million. And then I can purchase whatever combination I need to meet my minimum, say, for example, of the $1 million. Okay? So under the 200% rule, I can identify a lot more properties, but I'm going to have to be very careful to the dollar amounts that I'm going to be going into. And then the third rule means you have to buy everything you put on your list, because you've identified, it was a 95% rule. We don't have it in the slides here, but it's unlimited number of properties, unlimited dollar amount, but you have to close on 95% of the total. Very, very, very few people ever use that rule. Okay, it's very dangerous to use. So those are the guidelines for understanding the identification. Okay, as I said, the key component to identifying is that you want to make sure that you're doing it on time, you're filling the form out properly, and hopefully you're at least under contract with 1 or more of the properties that you're going to be acquiring. Okay. Now we get to the horror stories.
Well, that sounds very clear. Thanks for that great recap of the process and the rules. It seems pretty straightforward, so what could possibly go wrong?
Oh, many things.
All right, we'll start with some timing mistakes. You want to take it from here?
Okay. Okay, so what happens is, as I alluded to earlier about the 45 days, as an investor, the hardest part to doing the exchange is, to me anyway, is based on what we see coming through. And as a company, while I might have done over 10,000, as a company, we've done over 185 of these. So we're a national firm. So we see things all throughout the nation. What happens is that people lose sight of when that 45-day happens to be, or they do it wrong. The identification must be very, very specific. So common mistakes. People might put on there the street, they say, like, for example, here in the slide, 123 Main. Well, is it Main Street, Main Road, Main Circle, Main Place, Main Court? What city, what state? Because sometimes people will forget to put the state. For example, they'll put Norco. Well, Norco what? Louisiana or California? So you can see it has to be very specific. Sometimes they forget to sign the form. The form has to be signed. And then the other issue we talked about is, remember, it's calendar days. So they think it's working days or business days, when in actuality it's not. It's not. So how can you overcome that? Well, one of the things I think is important, most people, when they're going to fill out their identification, they're going to fill it out as it gets a little bit closer to the 45th day. If you start filling it out on day 10, you may be revoking and replacing your list 5 times over, and that'll get a little bit crazy after a while. So you're probably going to wait till you get closer to the 45th day. But it's very, very important that when you're ready to submit your identification, first of all, that you do it during business hours. Because sometimes people will wait till, say, for example, if the identification falls on a Saturday. You can submit it on Saturday, no problem. Our system, if you're working with asset preservation, our system logs in when we receive it. Okay, so if it's on a Saturday, it's due on a Saturday, you're fine. The problem is you did it wrong. When they come in the office on Monday to take a look at it, there's nothing that they can do to help you fix it. So if you send it, if it falls on a weekend, or even, or if it falls on a Friday, whatever day, get it in during business hours, because that way, if something's wrong, you have time to make the corrections. All right, so that's one way to help avoid certain issues with the identification. always be aware of when the 45-day period is. That time frame goes by so fast, and you can lose sight of it. So always have on your mind when that is going to be, okay? A different challenge that we're seeing today, because the market in certain areas is very tight, so there's not a lot of inventory. So when you're considering identifying properties, look to see what the level of inventory is in that area. That will probably relieve a little bit of stress if you're going into areas where there's more inventory. All right, so those are some of the issues when we're talking about, have happened with the identification. Because as I mentioned earlier, you cannot change your list once it's on there. Now, here's what happens from time to time. Have an investor that has identified multiple properties, let's say 3 properties, but in this particular case, they could only qualify for 2 loans. So what ended up happening is, because they were able to close on the 2, she couldn't close on the 3rd property. So and she ended up with a tax liability which on the boot, which is the portion that was not reinvested, which cost her $22,000. Okay, so how can you avoid something like this? Well, when you're dealing with an exchange, while you're working closely with the qualified intermediary, while you're working closely with your investment counselor, you also need to be working very closely with your lender, okay? Because you want to make sure that you're going to be able to get the financing you need based on the amount of properties you wish to acquire in the exchange. So while we're all in the same pond, we're not all doing synchronized swimming, what I like to say.
Okay. I'll talk about this one because this one actually happened to me. I was the investor, horror story number 3. So I sold 2 properties that I had for a while in Phoenix, but very close together, barely a month apart, and I started 2 1031 exchanges. So my plan was to sell the first property in 1031 into 2 properties in Tampa, and then the second one I was going to 1031 into 3 in Huntsville. However, the bank was unwilling to finance the Huntsville properties because the Tampa properties weren't leased yet. They were still vacant. So I almost missed the 45-day window on the second 1031. Fortunately, the Tampa property manager that we work with in the Tampa market was able to get signed leases in time, and the lender agreed to finance the second 1031. But that was a close call. I believe my day was Sunday, and I got the identification letter in on Friday. So my mistake here was I was so focused and fixated on the IRS's requirements, I forgot about other people, like the lender has requirements too, like not having vacant properties. So what I should have done was space them apart, like maybe sold one house in January and then wait a quarter and sell the next one in April, and give myself some time to close on the first set of properties and get them rented, and then do the second one. So there's a lot of moving parts in the 1031 exchange, the qualified intermediary, the IRS, the lender, all the inspections that have to happen. So it's better to spread them out and not try to do them too quickly. Live and learn. And the next one is a common thing, a common problem. Investor chose a new construction property as the replacement property. Now he was told the home was going to be built within 5 months, but because of bad weather and other delays, it was not completed even after the 6-month period. So he missed the 180-day window to close on that property, and so the exchange failed. So the investor, unfortunately, had to pay full taxes on the sale of his relinquished property. So what he should have done was choose either existing renovated homes like we have in the RealWealth network, or new construction homes that have a much shorter time window, like they're supposed to be done within 3 months into the future. So even if there are some delays, if there's bad weather or some delay in construction, you still have a couple of months and still be able to close within the 180-day deadline. If our investors
Joe,
go ahead.
I'm sorry. I was just going to say another thing that we'll see too. Then maybe you hold off the closing of your sale, especially if you're trying to buy into new construction, so your timeline doesn't start. So that's another potential option if you can get the buyer to wait, till you feel more comfortable that you're going to be able to close on that new construction.
Okay, that's a good one too. The clock doesn't start ticking until the first one's sold. Okay, so Yeah, for investors in the Real Wealth Network, if you are interested in new construction homes, we have plenty of them in North Texas and some of them in Florida. So those would be the ones to focus on if you do want new construction homes. Okay, that's it for timing errors. Now there's some more errors related to breaking the rules, and Dino's going to handle this section.
Okay. All right. One of the things that's important to understand about an exchange, and one of the key rules, is that when you're doing, as I mentioned earlier, you've got the continuation of ownership, right? So when we talk about continuation of ownership, I'm not only meaning the basis and the gain moves over to the next property, but also who's the taxpayer that sold and who's the taxpayer that purchased. So, for example, this was a situation that we heard about where there were just some business partners that owned property in an LLC, so they were being taxed as a partnership. It was showing on title that they were a partnership in an LLC. However, when they went to buy the replacement property, only one of the partners acquired the replacement property in their individual names. Well, the sad part about it is I don't know how that we would not have funded selling to buying completely different property ownership to what was sold in an exchange. But when you're doing something like that, even though the partner was owned, quote unquote, they were a member actually of the LLC, and a lot of times partners think they own the real property. Actually, the partnership is the entity that owns the real property. The tax code specifically excludes the ability of a partner to go out and buy real property in their individual name. And therefore, when something like that happens, their exchange will fail because it's not like kind. A membership interest is not like kind to real property. Okay, so basically what happened was a partnership sold and an individual purchased. Their exchange was invalidated under audit. All right, so how do you avoid something like this? You should always consult with your tax advisor before you're going to sell an investment piece of property. When you have entity issues such as partnerships, the key is that when you decide that you're going to sell this property and you own the property and the taxpayer is a partnership, you need to sit down with the members of the partnership and your tax advisor to determine, are you guys going to stay together when you buy the replacement property? If that's not the case, if you want to go your separate ways, then advanced planning, and when I say advanced planning, I'm talking a year in advance to two to be even more conservative, you take steps to change the ownership to tenant in common, season that ownership, and then ultimately when you put the property on the market for sale, you can go your separate ways. So you want to have a discussion with your tax advisor, okay, early on. Now, there are certain exceptions about certain LLCs and the way you may own title one way and then buy it in another, where it works specifically for an exchange. So, for example, on the slides here, it's talking about if you have a single member LLC that is a pass-through entity. So basically, the term you'll hear from a qualified intermediary is your LLC disregarded for federal tax purposes? Because while you're operating the property, you probably wanted to get an LLC for liability protection. But while you're reporting the property, everything is flowing to your personal tax ID number. When you sell that property, you may not want to carry that LLC with you to the next property. So then you go out and you buy the new property either in a new LLC or in your individual name. That works for the exchange because the LLC that sold was disregarded for federal tax purposes. Same with a revocable living trust. Sometimes we own our property in a trust. Maybe because of lender issues, the lender will not allow us to buy the replacement property in our revocable living trust. So we're forced to buy the property in our individual name. That still works because in both of the scenarios with the disregarded entity for an LLC and the revocable living trust, which is also disregarded, same taxpayer selling, same taxpayer purchasing. So there are times where it may not match completely on title, but as long as the same taxpayer is doing the exchange, it's good to go in that regard. I'm not going to speak about the rest of the transaction, but at least that aspect of it is. Okay.
Yeah, I like to speak to that too. When I did my 1031, just to show you how strict it can be, the relinquished property was under my abbreviated name, Joe Torre, and the replacement properties were under my full name, Joseph G. Torre. And I thought I was fine. It didn't occur to me that that could be an issue. But it's the same guy, same social security number. But Dino's company put on all the documents Joe Torre, also known as Joseph G. Torre, on all the documents as an abundance of caution, just to make sure that there'd be no problems down the road. So it was great to have her people there watching my back, because I would have never thought of that being a problem.
Oh, that's good to know. Oh, you know, one more thing about the LLC, and it kind of loops back to the lender issue. When you have two members of an LLC, and say it's a husband and wife, members of an LLC, in a community property state, you can be still a disregarded entity. In a non-community property state, you're going to be a partnership because there's two members. One of the things that we see are lender issues. So if, for example, the LLC is a husband and wife, and we'll say in a non-community property state, and they want to buy a replacement property, but the lender, because they may be buying one divorce, the lender may not allow them to purchase the property under the LLC. That will be a problem for the exchange. So if you have an issue where you have your LLC that is treated as a partnership, you want to make sure that you're getting a lender that will lend to that partnership, because that's another horror story that we didn't put in there, but is a true one with a 1031. Okay? So again, very important to have these conversations early on. Okay, now question comes up quite often. It says, you know, when I buy my replacement property, when can I move into it? All right. Remember I mentioned that when you're doing an exchange, the property, both from the sale side and the replacement property side, must be held for investment purposes. A primary residence is not an investment property. So people like to say, okay, I want to move into this property. You can do this at some future date, but your intent must be to do it, to buy the property and hold it for investment purposes. Now, here's a true story. Okay, taxpayer sold an investment property, claimed it as an investment. In reality, she moved into the property and was living in it. Figured that she could, you know, report income, quote unquote, on the property that she was living in to show it as an investment property. When she got audited, she was in big trouble because she falsely reported rental income. That's known as tax fraud, and she spent 14 months in prison. So when you're dealing with my world, it is a tax code. When you're signing your tax returns, you're signing it under penalty of perjury, okay, and fraud. I'm not sure the fraud's in there, but you get the point. If you're falsifying your tax returns, that's considered fraud, and therefore you could end up spending some time, like she did, 14 months in prison. Now, how do you avoid that? Well, you know, first of all, try not to engage in tax evasion, okay? But what she probably should have done was she should have rented out the property, established it as an investment property, talk to her tax advisor as to when would be appropriate time for her to ultimately move into the property to be able to substantiate the held for investment intent, okay? And then she probably would not have had these issues, because obviously in the 14 months in prison, she was not living at that property. So better yet, she should have rented it out for that period of time and then ultimately moved into it. It's about planning. It's about planning. So you want to make sure that you're following the rules and then you're not committing tax fraud, because that's something that never good in a 1031. Never. Okay?
Okay, last one on breaking the rules.
Okay, so here's another one. All right. This one, I have to say, every time I get a phone call like this, my heart drops along with my stomach. When you're doing an exchange, the exchange, as I mentioned early on, must be set up prior to the close of escrow. Even today, with all the education there is about 1031, I still get phone calls calling me saying, I want to set up my exchange after their sale has closed. Even though they have not touched the money, it does not qualify for an exchange. I mentioned early that the key to the exchange is my documents. If my documents are not in place, if my documents are not fully executed, there is no exchange, even if the taxpayer never touches the money. There's only 2 occasions where you do not need a qualified intermediary. One is when you're doing a simultaneous closing, so basically you're swapping. So if Joe and I each had properties and I wanted his property and he wanted mine and we did a swap, you don't need a qualified intermediary. Or if it's condemnation under a 1033, you don't need a qualified intermediary. Any other case, whether you're closing concurrently or not, you must have a qualified intermediary. So how do you avoid this? Engage the qualified intermediary before the closing. Last minute exchanges can be done. We have done them where people are getting ready to close the next day and we're preparing exchange documents and they're signed and executed, and that's fine. But it has to happen before the closing takes place. No exchange agreement, no exchange.
Okay, well, that's it for the rules. I'll go through the last 3 pretty quickly because we want to leave time for questions. The next 3 are about replacement properties. And in this example, the investor needed 3 replacement properties and identified 3 within the 45-day deadline. But after the deadline passed, one of the properties fell out of contract because of an appraisal issue, and it was too late to replace it on the identification list. So the investor had to pay taxes on the portion that she was unable to invest. Hate when that happens. So the way to avoid this is what she did wrong was she only identified the minimum number of properties needed for her exchange, and she was banking that all 3 were going to go through. What she could have done was used the 200% rule and identified more than 3 properties, maybe 4 or 5, just in case there was an issue with one of the first 3 that she really wanted. Now that's hard to do when buying from MLS because somebody else could buy the 4th or 5th property while you're waiting for your 1031 to go through. But with the RealWealth network, our affiliates can hold properties for you and see your exchange complete. So if they're holding 3 for you, and they might have a 4th property that they just purchased from a bank and they're in the process of rehabbing it and it's not going to be ready for sale in 3 or 4 weeks anyway, they can hold that 4th one for you as well, just in case one of the first 3 falls through. Then you have the 4th one to fall back on. The other thing the investor could have done in this scenario was, if she had additional funds available, she just could have written a check to cover the appraisal shortfall and closed on that 3rd property. It's okay to use additional funds. It's not like self-directed IRA money where you're not allowed to commingle IRA money with non-IRA money. In this case, you can mix 1031 money and non-1031 money and there's no problem. Okay, so next scenario is the opposite problem. The investor sold free and clear property, netted $500K. He thought with 25% down, he could buy $2 million worth of properties. That would be like 20 houses at $100K each. But identifying 20 houses within a 45-day window is really hard to do. And so he wound up buying properties he didn't want just to meet the deadline. So in this case, the investor's mistake was the exact opposite. In the previous scenario, the investor identified the minimum number of properties. In this case, the investor tried to identify the maximum number of properties and had to scramble to find 20 properties to fulfill his 1031. What he could have done was just buy the minimum number all cash. So in this example, 5 houses at $100K each. And then when the exchange was over, he could do a cash out refi with his lender and then take his time to purchase the right properties without being rushed. So in the RealWealth network, we're in the business of offering properties to investors, but sometimes the investment counselors like myself have to recommend to investors to buy fewer properties rather than more. And this is an example of when you might want to do that. So you're not rushing, you can buy what you really want later. All right, last horror story. The investor identified replacement properties from the MLS. Some properties had multiple offers and were bought by other people, owner-occupants, so the investor had to scramble and make offers on more properties to get 3 under contract within the deadline. One property's inspection revealed serious issues, but the seller wouldn't fix any of them because he knew the investor was doing 1031 and he had to close. So when the selling agent knows that you're doing a 1031 or the seller knows, then that kind of weakens your bargaining position. And you can't really avoid that because the title company has to work with the 1031 qualified intermediary. You can instruct your agent to not reveal that you're doing a 1031 for as long as possible, but sooner or later they're going to find out. So the way to avoid that is don't buy off the MLS. So one way, you could just buy through the RealWealth network. When you're doing a 1031, the affiliate will hold properties for you so they won't be bought by someone else. And if there are any issues with the inspection, they'll take care of them. Okay, so those are the 10 horror stories that come up quite often. So just to recap, 1031s are a powerful tool, but things can go wrong. There are certain things the intermediary can help you with, making sure you don't miss your deadlines, making sure you follow the rules. What they can help you with, which is on you and your investment counselor, is your selection of replacement properties, making sure you get the right number, too few or too many, or whether you try to buy a new construction that might not be built in time. Qualifying for financing, you have to work with your lender on that. Your qualified intermediary can help you with that, and negotiation with sellers. So hopefully these 10 scenarios will help you to avoid becoming a lead character in your own horror story. Engage a 1031 intermediary as soon as possible, and hopefully you can avoid these kinds of mistakes. All right, so we have a few minutes left for questions. A reminder, there's an orange dialog box at the top. You just click on that button and type in your question, and we'll see what questions we have. Okay, I've got quite a few here. Well, here's one. Here's a question about a duplex. If you live in one half of the property and you rent out the other half, can you use Section 1031 for the half that you rented and Section 121 for the half that you lived in?
I assume that question is to me.
Yes, I'm going to defer all the questions to you. You've done 10,000 1031s. That's 9,998 more than I've done. So you take it.
Very good. Okay. The answer to the question is yes. That's called split treatment. What you would need to know is you have to consult your tax advisor to determine what percentage of the property is your primary to what percentage is the investment. If it's 50-50, then it makes it very simple. If in some cases the owner-occupied unit may be a lot larger than the investment portion. So it's up to your tax person to let you know which portion goes to the primary residence and which portion goes to the 1031. So yes, you can do that.
Okay, great. We got a lot of questions here about reverse exchanges. Do you want to get into that? Because that's kind of complex.
It's very complex. I can cover it pretty basic and state that when you're doing a reverse exchange, you're having to close on the purchase before you close on the sale. What a reverse exchange is not is you getting under contract with the replacement property, but the replacement property closing after you close your sale. That's just excellent timing. So a reverse means you have to close on the purchase before you close on your sale. The big question when it comes to a reverse is where are you getting the funds to buy the replacement property? It's a very expensive and complicated exchange. It's not an exchange anybody should work toward. So in some cases, you have no choice based on the situation. But before you get yourself too deep into a situation where you'll be forced to do a reverse, you really need to speak with a qualified intermediary early on to determine whether you have the capacity to do that or not, based on everything we're going to be talking about. Yeah, it's a very complicated subject, but anytime somebody's thinking about doing a reverse, consult the qualified intermediary immediately to go through everything that's about to happen going forward.
Okay. Here's a question I should probably answer. When you say affiliates will hold homes, what does that mean? I should have been more clear. Basically, if you identify properties for an exchange with one of our affiliates, you just tell them that those are the ones you want, and you put them under contract, and so they'll have them for you. And it's not like MLS where somebody else can make another offer on them and buy them out from under you. Here's a question. Is the process the same if you want to buy into a DST versus a single-family replacement property?
The answer to that is yes. There is one quick nuance that will be different, and that's going to be the identification. When you're identifying into a DST, and DST stands for Delaware Statutory Trust, when you're buying into a Delaware statutory trust, you're not buying the entire building. So you have to be very careful as to how when you're identifying the specific percentage that you're acquiring. So, for example, you buy a single-family rental, you're buying 100%, you're going to identify the whole property. If you're buying into a DST, you might be buying 2.06537%. Okay, that's how specific it gets. Another component with the DST that you have to be aware of is sometimes when you're buying into a Delaware statutory trust, you're buying into a portfolio of properties. So there may be, instead of one property, there may be 5. Well, that's 5 different addresses that you're identifying. So now you're either in the 200% rule or you're in the 95% rule. Okay, so DST works the same. It is like kind in a 1031. You just have to watch your identification and make sure that you're doing it properly.
Okay. Madrigal says she wants to buy a property that costs less than the one she's selling. So she's going to have boot, right?
Yes, she will. So when you're doing something that's called a partial exchange, when you're making, and you can do that, the key for you to determine is to make sure that you're still benefiting from the exchange, because the government goes after what has not been the gain portion first. So if you're dropping too far down in value, so in other words, if your gain is less than your boot, so if your gain is, say, for example, $50,000 and your boot is $100,000, you're not benefiting from the exchange because you're going to pay all the tax anyway. If your boot was $25,000, then you're still benefiting to at least deferring the tax on the gain of the 25. So you can do a partial exchange. You just want to make sure that you're still going to benefit from the exchange.
Okay. Here's a question. How much does all this cost? What does it cost to engage a qualified intermediary?
I'm free in the beginning. The fees for a forward exchange are pretty relatively inexpensive for a 1031 and for all the work that we do, that's being done in the transaction. Asset preservation fees are $700 for the relinquished property, and then $300 for up to 3 replacement properties. We do not charge for wiring. We do not charge for redraws, any of that. We do not charge for FedEx. It's just a flat fee.
So about $1,000.
Yes.
Okay, that seems reasonable considering how much taxes you're saving.
And you've done exchanges, so you know how much work is involved, right, Joe?
Oh yeah, oh yeah.
There's a lot of work that goes on.
Okay, Kevin wants to know, how long do you have to rent an investment property before you can kick the tenants out and move in?
Well, Kevin, you better look to the local laws to see how fast you can evict your tenants. No, just kidding. But you want to make sure that you're holding the property for investment purposes. This is really a conversation that's going to be had between you and your tax advisor. Okay? When you're doing an exchange, you want to show that the property has been an investment property. If you move into the property within the same year that you acquired it, it's going to be a harder bar to cross to establish the investment intent unless you have some unforeseen circumstances that changed everything. So there's nothing in the code that mandates it, but there are a couple of cases out there that would point to too short is not good. The Goolsby case and the Adams case, for example. Both of their exchanges were invalidated. There was a third case called the Resync case, which their exchange was upheld because they had facts and circumstances that supported they intended to buy the property for investment purposes, but something changed and it altered their original intent. So you have to talk with your tax advisor. Longer is always going to be better than shorter.
Okay. Jessica wants to know, can you sell more than one relinquished property in a 1031 to purchase just one in a replacement property?
Jessica, the answer to that is yes. Now, here's the key that's going to be very important for the success of that transaction. So what you're talking about is consolidation. So you're selling 2 to buy 1. When you're doing a multiple property exchange, you want to make sure that the 2 properties are going to close as close together as possible, because the time frame for the exchange is going to officially begin at the closing of the first sale. Okay? For example, I had a client that was selling 4 properties, 3 in Texas, 1 in California. The one in California and the one in Texas were under contract with the buyer. The other two in Texas were not under contract. Fortunately, because of the market conditions, they were able to get all 4 of these properties closed within a short period of time so they can close on the one replacement property they wanted. So it's going to be about timing. So if you're going to try to accomplish something like that, depending on the marketplace that you're in, you want to be very clear that you're going to be able to have both of these properties closed within as close together as possible in order to try to accomplish this. All right, I feel very comfortable that you're going to get that second property closed before you have to close on the replacement property. I know that's a lot, I just said, but those are not easy transactions.
Okay, and they can talk to you later.
Yeah.
Let's see. Eleanor wants to know, I think I know the answer to this, but can the 1031 process be used for RWN syndication deals, like leaving one syndication when it's finished and rolling the money over into another syndication?
The answer to that would be no if the syndication is a partnership.
That's correct. Yeah, our syndications are not set up as Delaware statutory trusts, at least not so far. Maybe we'll do some in the future. But with a syndication, what you're essentially buying is shares of an LLC, and it's not really real estate. The LLC owns the real estate, but you, the taxpayer, don't own the real estate directly. So
yeah, sort of like the first example we talked about with the partnership issue. You're just flipping it around.
Yeah.
Okay, when the guy bought by himself, you're doing it the other way around. You're selling by yourself and buying into a partnership interest. It's completely excluded from 1031 treatment. You cannot do that.
Okay, and here's one. Can you sell your property to buy a replacement vacation rental, like an Airbnb?
As long as it's an investment property, the answer would be yes. If it's a vacation home where you're going to spend more than 14 days or 10% of the rental, you're going to have to be careful because now you're falling under whether it's a second home or vacation home, would it qualify? There's a Revenue Procedure 2008-16, which addresses that issue. But if it's strictly a seasonal or a vacational rental and your personal use is restricted, where you're not using it more than 14 days, is an investment property? That's the question. It doesn't have to be year-round rental. That's not a qualification for the exchange.
14 days, is that 14 days a month?
A year.
A year, wow.
That would be nice. Good try, Joe.
Yeah.
Remember, IRS. Revenue is their middle name. So.
If a husband and wife have IRAs, can they lend money to themselves from their IRAs to offset the loan required on the exchange?
Say that one more time.
Okay, if someone has IRAs, can they use the IRA money to lend themselves money to offset the loan on an exchange? So in other words, like in your $75,000 example, if they don't want a loan, take out a loan for $75K, can they lend themselves money from their IRA to pay that off?
Okay, I'm not an expert in IRAs, but I would assume that if you're taking money from your IRA, you're borrowing it, it's coming to you, and then you're using it to do that, and you're paying your IRA back.
Right.
It would seem like it would work, but I would consult your tax advisor. I'm not an expert in IRAs.
Okay, well, we're coming up on the hour here. Let's see if we have time for one more. How do you recommend managing 4 beneficiaries on an inherited single property worth over $5 million? I guess it depends on whether they want to buy a replacement property together or not.
Well, yeah, at that point, you're talking about if you have beneficiaries, that means that the trust has gone irrevocable. So the trust at that point is the taxpayer that owns the property. And so that would be the entity doing the exchange, not the beneficiaries.
Okay, last one. Gentleman and his daughter have a property upstate New York where she went to school. After she left school, they converted it to a rental. So can they do a 1031 on that property?
As an investment property? That
Yes.
would be, how long has it been an investment? Yeah, it's just so, if it's a rental now, it probably should qualify. Consult your tax advisor. I know Joe hears me say this all the time.
Okay, I think that's about all the time we have for questions. If you're interested in learning more, we didn't get to all the questions, so you can contact your investment counselor and we can put you in touch with Dino. If you don't have an investment counselor, you can see the screen there. You just go to realwealthnetwork.com/connect and you can sign up with one of them and continue this conversation further. Also, we have a reminder that we have our live events this weekend in San Mateo, LA, and San Diego, and Kathy will be there to greet you all. So thank you very much, Dino, for that very informative presentation. Part of this game of investing has to do with not losing, because you could make one mistake and wipe out the money you make on a lot of good investments by having one bad investment. So avoiding mistakes like this really helps out. Thanks a lot for giving the presentation today.
Thank you, Joe, for inviting me. I appreciate it.
Okay, that concludes today's webinar, everyone. We'll sign off now, so enjoy the rest of your day. Bye.